October mornings in the late 1920s carried a kind of confidence that felt almost supernatural. The sun rose over American cities like a spotlight on a stage where prosperity wasn't just expected, it was assumed. Businessmen stepped off streetcars and subways with the calm of people who believed the future owed them wealth. Typists filled offices with the steady rhythm of keys tapping out letters about rising profits and new expansions. And across the country, ordinary families planned vacations, bought radios and cars on installment plans, and watched their savings swell in a stock market that seemed to obey no law except upward motion. It was a nation intoxicated by its own success. A nation convinced that it had finally cracked the code of endless prosperity. Newspapers declared that America had entered a permanent era of growth. Politicians praised the unstoppable strength of the economy. And financial experts, men with degrees, charts, and reputations, assured the public that the old worries about risk and downturns were relics of a primitive past. People believed them. Why wouldn't they? Factories were booming. Credit was easy. Everywhere you looked, wealth seemed to be multiplying like a natural force, as inevitable as the tides. But beneath the celebration, almost invisible in the noise of national optimism, something fragile was forming. Attention. A hairline crack in the foundation of a dream built too quickly, on too much borrowed money and too much blind faith. And yet nobody wanted to see it. Because to see the danger would mean admitting that the prosperity they trusted was not as solid, not as eternal as they hoped. This was the illusion before the fall, an illusion millions were willing to believe, even as the ground beneath them quietly shifted. They weren't just living through a prosperous decade. They were living inside a bubble nourished by one seductive belief. This time nothing could go wrong. This time the good times would last forever. But history has a habit of whispering warnings long before disaster arrives. And in the final days of the 1920s, those whispers were growing louder, even if almost no one was listening. America in the 1920s didn't just feel prosperous, it felt invincible. The country had emerged from World War I not broken and exhausted like Europe, but stronger, richer, and more confident than ever before. Its factories were running at full speed. Its banks overflowed with foreign gold. Its businesses were expanding into new industries faster than newspapers could report them. And for the first time in American history, ordinary workers, people who had once counted every penny, could suddenly afford luxuries their parents had only dreamed of. Radios filled living rooms with music and news from miles away. Electric refrigerators replaced iceboxes, humming with the promise of modern life. Washing machines and vacuum cleaners turned chores into conveniences. And automobiles, once a symbol of wealth, now lined the streets of every town and city. It felt like the future had arrived early. Like progress itself had become unstoppable. Henry Ford had perfected mass production, turning cars into something the average family could buy with a few dollars down and a signature on a credit form. Electricity spread across the nation, lighting homes and businesses from coast to coast. People didn't just feel richer, they lived richer. And with the explosion of consumer credit, a simple idea took hold. If you couldn't afford something today, you could afford it tomorrow. Buy now. Pay later. Why wait for prosperity when you could borrow it? But this new optimism came with a dangerous side effect. When people feel wealthy, they begin to act wealthy. They spend more. They take bigger risks. They convince themselves that the good fortune they're experiencing isn't temporary, it's deserved, permanent, guaranteed. And nowhere was this illusion stronger than in the stock market. What had once been a place for seasoned traders and wealthy investors was quickly becoming the national obsession. Barbers gave stock tips between haircuts. Taxi drivers compared their portfolios with passengers. Secretaries pooled their savings to buy shares in companies they barely understood. Teachers, shopkeepers, farmers, everyone was joining in. The market wasn't just an investment anymore. It was a cultural phenomenon, a symbol of American genius, a proof that the nation had discovered a new formula for endless wealth. Stocks soared year after year, climbing so fast that even skeptics stopped asking whether the prices made sense. Because every time someone hesitated, the market answered with another surge upward, as if reassuring them that doubt was unnecessary, maybe even foolish. And with every rise, confidence grew. And with every surge, the belief hardened. The stock market couldn't fail. Not really. Not anymore. But beneath the optimism and the credit and the frenzy, something else was growing, something nobody wanted to acknowledge. The more people believed they couldn't lose, the more catastrophic their losses would eventually become. By the mid-1920s, the stock market wasn't simply rising, it was exploding. It moved with a kind of reckless confidence, as if gravity no longer applied. People didn't invest because companies were strong or profits were growing. They invested because everyone else was investing and getting rich overnight. It was the purest form of financial euphoria. A nationwide dream that seemed to reward optimism and punish caution. Between 1924 and 1929, the Dow Jones Industrial Average didn't just climb, it tripled. Stocks that cost $50 in the spring were worth $100 by summer and $150 by fall. Fortunes were made in months, sometimes in weeks, and every early winner became living proof that the system worked. But the true fuel behind the boom wasn't savings or wages or business profits. It was credit. The same buy now, pay later mentality that put refrigerators in kitchens and cars in driveways was flooding onto Wall Street. Investors discovered a seductive new financial trick called buying on margin. It worked like this. Put down 10% of your own money, borrow the other 90% from your broker, and buy as many shares as your imagination could handle. If the stock rose, the profit was almost magical. Not because you were smart but because you were leveraged. If it fell, well, nobody talked about that. After all, stocks only went in one direction. By 1929, margin buying had become so common that brokers had issued over $6 billion in loans, a staggering amount, equivalent to tens of billions today. The entire market had become a towering structure of borrowed money stacked on top of borrowed confidence. And it felt wonderful. It felt unstoppable. It felt like America had discovered how to turn belief itself into profit. Even the icons of the age fed the illusion. Joseph Kennedy made millions speculating. Jesse Livermore became a legend for timing the market like a prophet. Magazines published headlines like, "Everyone ought to be rich." And respected economists publicly declared that stock prices had reached a permanently high plateau. The word risk didn't disappear. People simply stopped caring about it. Because when the entire country is getting rich, who wants to be the one voice saying, "Be careful"? Who wants to admit that the foundation of their fortune is fragile? Who wants to believe that the party they're enjoying could ever end? Confidence became a currency more powerful than dollars. And it was everywhere, in homes, in newspapers, in banks, in Congress, and on every trading floor across the country. It was the oxygen that kept the bubble alive. But bubbles don't burst because people run out of money. They burst because people run out of certainty. And beneath the surface, quietly, slowly, that certainty was beginning to fade. A few economists whispered concerns about slowing corporate profits. Some analysts pointed to rising unemployment and weakening farmland economies. A handful of bankers warned about the dangers of soaring debt. But their voices were drowned out by a much louder chorus. But, borrow, believe. The future belongs to the fearless. America wasn't listening to warnings anymore. It was too busy celebrating its own brilliance. And the higher the bubble rose, the more catastrophic its fall was destined to be. By 1928, the American economy looked perfect from a distance. But only from a distance. Up close, the shine began to fade, revealing small cracks that hinted at something deeper, something dangerous. Corporate profits, the engine that was supposed to justify soaring stock prices, weren't rising fast enough to keep pace with the optimism on Wall Street. Factories were producing more goods than consumers could buy. Unemployment, which had been low for years, began to creep upward as companies replaced workers with machines. Farmers, the backbone of the early American economy, were drowning in debt as crop prices fell year after year. But none of this made the headlines. It didn't fit the narrative of endless prosperity. And in a decade intoxicated by good news, bad news was treated like a rumor, an inconvenience, something impolite to repeat in public. Even the Federal Reserve saw danger and tried to cool the frenzy by raising interest rates. But instead of slowing the bubble, the move made it more fragile. Borrowing became more expensive, yet the market continued to lean heavily on credit. Like a skyscraper built higher even as its foundation weakened. Still, the optimism didn't fade. It simply grew louder. Newspapers celebrated stock market gains like sporting victories. Radio shows praised the bravery of everyday Americans becoming investors for the first time. Department stores reported record sales, fueled by consumers who believed their growing portfolios would pay for everything eventually. Politicians congratulated themselves for presiding over the greatest boom in American history. Every new success story, real or exaggerated, fed the illusion. Every neighbor bragging about a lucky investment convinced 10 more people that they too could strike gold. Greed disguised itself as intelligence. Confidence disguised itself as stability. And through all of this, the same dangerous belief continued to spread. If everyone is getting rich, nothing bad can happen. But the warning signs were everywhere if anyone cared to look. Stock prices were 3 times higher than they had been just 5 years earlier, completely detached from the underlying realities of business performance. Banks were writing loans backed by volatile share prices, treating stocks as if they were as safe as cash. Companies were borrowing against their own soaring valuations, expanding on the assumption that the market would always support them. It was a tower built on promises. A system held together not by strength but by belief. And that belief was beginning to tremble. A few cautious observers sounded the alarm. Financial forecaster Roger Babson warned repeatedly that the market was built on speculation, not substance, predicting a crash that would be devastating when it finally came. But his warnings were dismissed as jealousy, pessimism, or outright ignorance. How could he be right when everyone else was making money? How could danger be real when the numbers kept climbing? In the minds of millions, the idea of a decline, a real decline, was unthinkable. The nation had become addicted to rising prices. Any dip, any wobble, any sign of weakness was dismissed immediately as a buying opportunity. The confidence was absolute. And absolute confidence is always a trap. As the calendar drifted toward the fall of 1929, the tension grew, quietly, invisibly, like the tightening of a rope. The system was stretched thin, held together by leverage and luck. All it needed was the smallest shift in psychology, a flicker of doubt, a moment of hesitation, to start unraveling. And that moment was closer than anyone realized. By the autumn of 1929, the American financial system looked impressive, towering, dazzling, and seemingly unshakable. But like a skyscraper built on sand, it was far more fragile than anyone dared to admit. The stock market had become the foundation of middle-class wealth. Teachers, clerks, factory workers, people with modest incomes, had poured their life savings into shares they believed represented America's future. Even families who had never imagined owning stock a decade earlier now held small portfolios, convinced that investing was their ticket to a better life. Banks, once conservative institutions, had become major players in the frenzy. They issued billions in loans backed not by farms, homes, or businesses, but by shares whose value depended entirely on perpetual optimism. To bankers, the rising market felt like free security, collateral that always increased in value, requiring little effort and no oversight. Corporations joined the celebration too. Many borrowed huge sums using their own stock as collateral, betting their expansion plans on the assumption that rising prices would continue forever. And as long as the market went up, everything seemed fine. The entire system was interconnected, tightly, dangerously. Every layer supported the next, each one relying on the others to stay stable. It was a house of cards disguised as a fortress. But beneath this glittering structure, leverage was quietly turning every risk into a catastrophe waiting to happen. Here's the cruel truth of leveraged markets. Confidence isn't helpful, it's essential. Without it, everything collapses at once. The more people borrowed, the more they depended on stocks rising. The more stocks rose, the more people borrowed. It was a self-reinforcing cycle of optimism, until the very moment it wasn't. And the smallest tremor could bring the whole thing crashing down. By September, the market began to flicker in ways only professionals noticed. A few stocks fell sharply before bouncing back. Trading volumes surged during declines, a subtle sign that major investors were quietly stepping away from the table. Margin calls, once rare, began to increase. Behind the scenes, the smartest money in America was slowly, carefully, silently moving toward the exits. Not because they knew exactly when the bubble would burst, but because they could feel the air getting thinner. Meanwhile, ordinary investors saw nothing but opportunity. If prices dipped, they bought more. If rumors spread, they dismissed them. If anyone warned them, they laughed it off. After all, hadn't every dip for the last 5 years been followed by an even bigger rise? To them, hesitation looked like weakness. Caution looked like ignorance. Fear looked like foolishness. But markets don't crash because of numbers. They crash because of psychology, because the very belief that keeps the system alive suddenly evaporates. And in late October 1929, that belief was hanging by a thread. The optimism that had built the boom was turning brittle. The confidence that had fueled the rise was beginning to crack. And the weight of trillions of borrowed dollars was pressing down on a structure never meant to hold so much risk. The entire nation was standing on a cliff, smiling at the view, unaware that the ledge beneath them was starting to crumble. The fall had not yet begun. But it was inevitable. And when it came, it would be faster, deeper, and more devastating than anything America had experienced before. Monday, October 28, 1929 did not begin with panic. It began with something far more unsettling: silence. Wall Street's usual morning energy felt muted, as if the city itself sensed a shift in the air. Traders moved with a stiffness they couldn't explain. Clerks whispered instead of joked. Veterans of the market, men who had lived through booms and busts, felt the same eerie tension that precedes a storm. The opening bell rang at 10 a.m. But instead of the confidence surge that had become routine, the market wobbled, uncertain, hesitant, fragile. General Electric opened lower. U.S. Steel slipped at the start. RCA, the darling of the decade, stumbled immediately. At first, nobody panicked. They'd seen morning dips before. 4 or 5 straight years, every moment of weakness had been followed by triumphant recovery. Doubt had always been conquered by confidence. Fear had always been erased by greed. That was the script. That was the pattern. That was the comfort everyone clung to. But this time something was different. The smart money, the professionals who usually stepped in to buy during dips, wasn't buying. It was quietly, almost stealthily selling. They saw what ordinary investors could not. The sudden spikes in volume on downswings, the reluctance of buyers to hold the line, the growing pressure of margin calls hitting leveraged traders behind closed doors. Confidence, the invisible force that had lifted the market for years, was beginning to crack. By midday, the weakness was no longer a rumor, it was reality. Stocks were down 10%, then 15%, then 20% in a matter of hours. The ticker tape fell behind, unable to record trades fast enough. Prices changed faster than clerks could shout them out. And for the first time in years, investors felt something unfamiliar and unwelcome. Fear. Margin calls, once rare and often ignored, now came in relentless waves. Brokers demanded more collateral. Investors scrambled to find cash. Some called banks. Some called family. Some called no one because they already knew the truth. They were trapped. In a leveraged market, you don't get to choose when you sell. Your debt chooses for you. And now the forced selling had begun. Each liquidation drove prices lower. Lower prices triggered more margin calls. More margin calls triggered more liquidations. It was a chain reaction, mechanical, unstoppable, merciless. A system built on confidence was now collapsing under the weight of its own leverage. By the closing bell, billions in paper wealth had vanished. Fortunes had evaporated. People who had gone to lunch feeling wealthy returned to their desks feeling uncertain, shaken, vulnerable. Yet even then, even after one of the worst days in market history, many still believed it was temporary, an overreaction, a painful but short-lived correction. Newspapers urged calm. Experts reassured the public. Politicians insisted the fundamentals were sound. But in brokerage houses across the country, the truth was impossible to ignore. Margin clerks worked late into the night calculating Tuesday's demands. Traders stared at numbers they hoped were wrong. Bank officers examined loan portfolios that no longer looked safe. Something profound had broken, not just in the market but in the nation's psychology. Monday had shaken the house of cards. Tuesday would bring it crashing down. Because once confidence breaks, it never falls alone. Tuesday morning, October 29, 1929, did not feel like a new day. It felt like an aftermath. The kind of heavy, breathless stillness that settles over a landscape just before people realize the storm hasn't ended. It's only gathering strength. Across the country, Americans woke with a kind of nervous hope. Maybe Monday had been a mistake. Maybe the newspapers were overreacting. Maybe the system they trusted was stronger than a single bad day. But the headlines waiting on their doorsteps told a different story. European markets had plunged overnight. London was battered. Paris was shaken. And sell orders from terrified investors around the world were already flooding into New York hours before the exchange opened. The first hint of truth arrived before the bell even rang. Monday wasn't the crash. It was the warning. At 10 a.m. the market opened, and all illusions evaporated. There was no hesitation. No hopeful bounce. No moment of stability. The selling began instantly, violently, endlessly. General Motors dropped 20 points at the open. Westinghouse collapsed so quickly the price quotes lagged minutes behind reality. RCA, the stock that had made more millionaires than any other, fell so fast that traders were shouting numbers, not because they were executing trades, but because they could barely process what they were seeing. The ticker tape, once the proud heartbeat of American prosperity, became a tormenting reminder of a world spinning out of control. It ran hours behind, printing prices that were already obsolete by the time anyone saw them. Investors weren't just losing money, they were losing track of how much money they had lost. By the time they read a number, the market had already fallen further. It felt like trying to steer a sinking ship using yesterday's map. The New York Stock Exchange had never seen volume like this. Systems designed for 3 million shares a day buckled under 16 million. Clerks' hands shook as they processed sell orders that represented people's life savings. Phone operators cried as they answered calls from investors begging for updates, begging for mercy, begging for a reality that no longer existed. And hovering above it all in the gallery were the spectators, hundreds of ordinary Americans who had come expecting to witness the excitement of Wall Street, and instead watched the nation's wealth dissolve in real time. But the worst damage came from the same force that had built the bubble in the first place. Leverage. Margin calls hit like hammers. Investors who had already drained their bank accounts on Monday now had nothing left to give. Brokers didn't wait for permission, they liquidated everything. Homes were sold. Businesses were lost. Life insurance policies, family heirlooms, retirement dreams, all fed into the machine as collateral that could never be redeemed. Each forced sale drove prices lower. Lower prices triggered more margin calls. More margin calls triggered more forced sales. By midday it wasn't a market anymore. It was a cascade, brutal, mathematical, unstoppable. Banks were the next to fall under the weight of their own decisions. Loans backed by safe blue-chip stocks were suddenly backed by assets worth half, or a third, of their original value. Deposit holders, once confident, began whispering about withdrawals. Executives who had celebrated financial innovation now stared at ledgers that spelled out a future they had never imagined. Insolvency. Small towns across America felt the shock almost immediately. Local banks had invested deposits in the market or lent money to farmers and shopkeepers who had put everything into stocks. When the market collapsed, their customers collapsed with it. And when their customers collapsed, so did they. By afternoon, the most powerful bankers in the country, J.P. Morgan Jr., Thomas Lamont, and others, gathered in emergency meetings hoping to slow the panic. But even they couldn't stop a tidal wave made of fear, leverage, and collapsing confidence. By the closing bell, the Dow had fallen nearly 12% in a single day. Individual stocks were down 30%, 40%, even 50%. Billions of dollars of wealth didn't just change hands, it evaporated. It became clear to everyone watching. The prosperity of the 1920s had been an illusion. A beautiful, convincing, dangerous illusion held together by belief, and belief alone. And on that Tuesday belief died. When the markets finally closed on that dark Tuesday in October, the country exhaled, not in relief but in shock. People stepped out of banks, out of brokerage houses, out of offices and factories, and looked at one another with the same quiet, frightened expression. What just happened? How could everything change so fast? How could wealth that felt so certain on Sunday vanish by Wednesday? The truth settled slowly, painfully across the nation. They had not lost money. They had lost an illusion. The prosperity of the Roaring Twenties had always lived on borrowed time. On borrowed money. On borrowed confidence. For years, Americans had believed that the old rules no longer applied. That risk was outdated. That debt was harmless. That prices could rise forever if enough people believed they would. And when that belief cracked, just for a moment, the entire structure collapsed with breathtaking speed. Families who once spoke proudly about stock portfolios now spoke quietly about survival. Banks once considered unshakable closed their doors. Communities watched dreams dissolve into dust. And the nation entered a decade of hardship that nobody had imagined during the glittering days of the boom. But the most important part of the story isn't what happened in 1929. It's what happens every time people convince themselves that they are smarter than history. Because this wasn't a unique failure of an innocent time. It wasn't a rare mistake. It wasn't a fluke. It was the predictable result of a familiar lie. This time is different. That lie has whispered its way through every financial bubble since. Housing bubbles. Tech bubbles. Crypto bubbles. Debt bubbles. Every era dresses it in new clothing, gives it a new shape, a new name, a new justification. But beneath the disguise, it is always the same voice. Ignore the risk. Trust the crowd. Borrow confidence and call it wealth. And every time, without exception, the outcome is the same. When confidence grows faster than fundamentals, it becomes a bubble. When optimism replaces caution, it becomes a danger. And when an entire society builds its future on faith rather than reality, the collapse is not a matter of if. It is only a matter of when. The people of 1929 learned this the hard way. Their tragedy became a warning etched into history. A warning that remains as relevant now as it was then. Because markets change. Technology changes. The world changes. But human nature? That never does. And as long as we continue to believe that prosperity can be built on hope alone, As long as we choose comforting illusions over uncomfortable truths, as long as we treat borrowed money as real wealth, we will keep repeating the same mistakes again and again across generations. The crash of 1929 is more than a chapter in a history book. It is a mirror, reflecting our own habits, our own temptations, our own blind spots. And if this story gave you even a moment of clarity, if it shifted the way you think about markets, risk, and the cycles that shape our world, then remember this final lesson. History doesn't repeat, but it rhymes, loudly enough for anyone willing to listen. And if you want to understand those patterns, not just from 1929, but from every era of financial boom and bust, subscribe to Finance Archives. Because the most dangerous bubble is the one you don't recognize until after it bursts.